We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Bob Thompson, Senior Portfolio Manager at Raymond James. Thanks for joining me again today, Bob.
Great to be on again, Tom, and got so much to talk about, I think.
Man, do we ever. And of course, we're speaking on the morning of Tuesday, April 4th here. You know, gold is up over $2,000 this morning. But, you know, you and I were kind of jokingly saying that this is a time to be conservative with your emotions. And we'll get to that later in the call here, but why don't you give us a little refresher on your background and your focus as a portfolio manager here to get started?
Sure, Tom. You know, I've been in the industry about 27 years now, so saw lots of ups and downs. And we focus a lot, or we deal a lot with senior mining executives. And I think it's important to realize that, you know, this sector is very cyclical, right? The gains are huge when they happen, but then you tend to give it all back a lot of times in the downturn. So, you know, from a planning perspective, if you're a ultra high net worth senior mining executive, you can capture kind of the big gains when things happen, then diversify your assets, make sure you can create a legacy for yourself, make sure your kids can go to school, make sure you can do all the things you want to do from a lifestyle perspective. You know, that's what we focus on a lot. So I think it's important that obviously, you know, the mining sector extremely well, but we also know how to diversify and preserve your profits for the next downturn when it happens, which it will happen. Guaranteed, it will happen in this sector.
Mm-hmm. Yeah, of course. You know, as you say, mining is one of the most cyclical markets that we can look at, and again, we'll get to that a little bit later. But
sure.
why don't we evaluate, let's say, the economic and the financial landscape since the last time we spoke? How has it changed? And you know, of course, we need to touch on the failures in the US banking system. Has that spurred a lot of interest for the metals for the general investor?
Sure. You know, last time we talked, we were kind of talking about in the future, the Fed was going to have to back off on their interest rate increases, and we knew that was going to happen. It has to happen, and here we are. We're at that point now. But the big thing is that the Fed will raise interest rates until they break something, right? And you never know what they're going to break, but something's going to break, right? And because all of the excesses from zero interest rate policy, you know, show up when you start to raise interest rates. You know, the old saying, you don't know swimming naked till the tide goes out. Well, we're seeing who's swimming naked now, right? The tide's going out, interest rates are going up. But I want to really focus on that in relation to what's happening with this banking situation right now. This always happens over and over again. So let's go back to the late 80s. You had the savings and loan crisis, right? Due to, we all know that in the 80s, things were booming, right? In 1982, the stock market bottomed, and then we had this massive run in the stock market in the 80s. Well, that created all kinds of excesses, right? Fed starts to raise interest rates. They start to get a little concerned about inflation, whatever, but it caused the S&L crisis in the late 80s into the early 90s. Then the worst year for bonds was 1994. So the Orange County crisis, where Orange County kind of blew up their investment portfolio and went bankrupt, right? That was a similar sort of situation to now, because they were positioned based upon what they thought the Fed was going to do, and it didn't happen. So then we get into 1997, 98, where the US dollar rallied dramatically. Then we started to raise interest rates. We got long-term capital management, kind of almost blew up our financial system, right? Then we go into 2001, 2002. We got the tech bubble, and we can talk a little bit more about that, how things relate today to what we saw at that time. You know, then we all know 2008, and that because of excessive leverage in the system, a lot of it caused by the Fed's policies. And then here we are again with zero interest rates for so many years. I mean, Goldman Sachs did something a while ago that said that interest rates were lower a few years ago than they had been in 5,000 years. And how they came up with that is that money was free, right? Money's never been free. You can never in history have you ever been able to lend money to somebody and get nothing in return, right? So that's how they came up with that. Well, that causes excesses, right? So these banks out on the fringes to they believed the Fed that we were going to raise interest rates for a few years, so they kind of went into some investments, not risky investments. They went into bonds, but they were over leveraged in things that had a huge downturn, and that's obviously put pressure on their balance sheets and caused people to take money out of. Any crisis always is exacerbated by the emotional impact of it, right? So people wanting to take their money out, and this mass exodus, and obviously you got to stop that. So that was a history of the last 30 years of all the kinds of financial crises that have been caused by interest rate policy. So here we are breaking the system again, and when that happens, obviously the Fed now has to step in, and I wouldn't be surprised if last year we saw some of the in the shortest period of time, we saw the largest interest rate increases in the shortest period of time in at least half a century. And I wouldn't be surprised in a year or two to see the fastest interest rate reductions in history that start to happen, right? Because obviously they've overdone it.
Mm-hmm. So, Bob, what makes these banks, important from an economic perspective, even though they really only accounted for 1% of the market?
Right. That's a great question, because everybody thinks of regional banks. In Canada, where I live, we have a few major banks, right? And they do most of the lending. In the US, it's a lot more diversified. So you've got some really big ones, but you got a lot of these regional banks who lend to people in their community, right? Or lend to people in their state or in their region. So although they only represent about 1%, like you said, they represent almost half of the commercial loans and industrial loans and small business loans and things like that in their region. So it's very, very, very important to the system when you get a lot of stress in these regional banks. And as we know, a bank will only lend money to you if you can prove to them that you don't actually need the money, right? If you actually really need money, banks will lend to you. So why that's important is because right now, going into an economic downturn where people are going to need more money, that's exactly the point where banks are going to start to tighten up on their credit, and they're not going to lend out. And that just makes problems worse when that happens, but it's just a natural function of the market. So with this regional banking crisis, a lot of them having to go to the Fed to borrow some money, that means that there's going to be tightening on that side, which just makes the economy slow down even faster.
And if you could, Bob, help us put into perspective, the scope of what just happened. How much did U.S. banks already borrow from the Fed? Is that more than in 2008? Right.
So what happened here, and it's kind of been brushed over, but the Fed had to step in very, very quickly. And on Jay Powell's last press conference, he looked really weary to me. He looked kind of really tired, because I think he had to spend probably 4 or 5 or 6 days having to again solve a problem that was caused by these big interest rate increases. So what they did is they said they opened up what they call a discount window, which means if you're a regional bank and you're getting lots of people taking your money out, you can go and borrow from the Fed, borrow money based upon the fact that you can get it on better terms than what you could normally do, right? So they actually used that and took out about $140 billion out of the discount window. In 2008, that number was about 110 billion. So actually, this was 25% worse, or more money that was taken from the Fed than during the 2008 crisis. And a lot of people don't realize that. Mm-hmm. So they had to plug a hole again, but again, that causes more issues in the system. Mm-hmm. So you just feel like they're chasing problems, right? Mm-hmm. Right. When this sort of thing happens, problems all pop up, and you gotta just like whack-a-mole. You got to knock that one down, and then something else pops up. You got to knock that one down, and that's what they're in a state of doing right now, is that whack-a-mole. Mm-hmm.
So, we talked about the fastest rate hike cycle in history. Obviously, a lot of this is because of that rate hiking cycle. So what do you see forward as the path for the Fed here? Do they keep hiking and, backstopping these failing institutions, mm-hmm. which is in some ways giving them the ability to have a soft landing that they're looking for?
Right. Well, generally speaking, the consensus is out there that everything is going to be great with interest rates at this number, right? And I just have trouble believing that, because we have to look back. Why did they leave interest rates at zero for so many years? Because the economies weren't growing, right? With normalized interest rates, the economies wouldn't have been growing; they would have been declining, and that's demographics, productivity. There's lots of reasons for that being the case. So I really find it hard to believe that if the economy couldn't or barely grew at 0% interest rates, that suddenly at 5% interest rates, it's going to be great. Everybody's going to be borrowing and the economy is going to grow dramatically. So I don't think it's going to happen. So interest rates still would have been down at those very, very low levels unless inflation had reared its head. So we're in this environment where the Fed is kind of backed into a corner, right? So they've raised interest rates so dramatically to beat down inflation, but they're going to maybe cause a severe economic issue, which means they're going to have to back off, and then inflation will rear its ugly head again. And I think it pertains to what we're talking about here, not necessarily on gold, because gold's a monetary metal, but the other metals. There hasn't been any there hasn't been any increases in supply or capex for the past 11 or 12 years in copper and zinc and all the other base metals, and energy is another area, oil and gas. So, as soon as they start to back off a little bit, we're going to see some major supply issues with these metals, and you're going to get these commodities kind of rising up in price, and that causes commodity price inflation when that starts to happen. And nobody expected a 70s type environment with inflation and commodity prices. Nobody expected, which told me that there was a high probability that was going to happen, right? Because you know how the market works, Tom, right? The market is geared for the least amount of people make the most amount of money. That's always the case. Not everybody can become a billionaire. Not everybody can make a lot of money. Only a very small percentage of people. So that's why, the old saying of take the consensus, whatever the consensus says, take the opposite side of the consensus and be right. And that's how you make the big money. And that's a very small percentage of people. That gets into behavioral finance and all kinds of things, which we can talk about too later on.
Pareto's law, I believe.
Right. 80-20, sure.
So, Bob, do you think the Fed has hiked too much already?
Yeah, I personally do. But they figured they had to beat inflation. And I think this was very important. And I'll get back to that in a second. But this was very important in Jay Powell's last conference, or sorry, not his conference, but when he was talking to the banking committee. He basically said, inflation isn't that important. What's most important is what people expect inflation to be, right? And you have to hammer down inflation expectations, because if people expect inflation to run, then they're going to go buy their cars and do everything else. And you see these lineups in Argentina where everybody's lined up because the next day the prices are going to be 100% more. So they got to get it today, which causes more inflation. And then you're out of control. And I think that was very important. So that's why they keep hammering on the fact that 2% inflation is where we're going back to. I don't know what's in their head, but they might have already figured out that it's not going to get back there, but they can never say that, right? Because they have to make sure that people expect that inflation is going to go down a lot. So by raising interest rates the way they have, I think they knew they were probably going to break something. They just hoped they weren't going to break something that was going to break the entire system. They've done that. I think inflation expectations have gone down a lot, and that's what they were trying to do.
Just kind of putting this into perspective, if we could, Bob, what is the average time in the US from the last rate hike to the first cut?
It's only a few months, really. And that kind of follows up on your last question. They usually overbake the turkey, right? And the reason they do that is because it takes a long time for interest rate increases to show up in the economy. In other words, if you and I had a contract for me to buy something from you, we might have made that contract 6 months ago, right? So I'm still bound by that contract. So whatever interest rates are right now, I'm still buying from you based upon our contract that we did months ago. So that's why it takes a long time to filter through the system. But the problem is the Fed is kind of going on, today's numbers that they're looking at, and basing their decisions on today's numbers, which actually reflect what was happening 6 or 8 months ago, right? So when you look at the leading indicators, which for some reason they don't really do that a lot, they kind of look at today's numbers. They're always going to be behind the curve, right? Whether it's raising interest rates or lowering interest rates, and that's why they kind of always have to do a catch up. And interestingly enough, the Fed's missed most recessions that were going to happen, right? But again, in fairness, they can't ever say a recession is going to happen. Can you imagine if Jay Powell said, "Hey, next year we're going to have a serious recession. There's going to be millions of people out of work. It's going to be terrible." Well, they just created a serious recession, right? because everybody's going to pull back, et cetera. So they can never say that. But one of the best money managers ever, Stanley Druckenmiller, said recently. He said, the reason, and he's averaged 30% a year over 30 years with no down years. He said the reason he's been able to kind of out forecast the Fed, which he's done throughout his entire career, is he said, I look at market inputs. I see what's happening actually in the financial markets, where the credit spreads are, what the market's telling me about what's happening with the economy. And he said, the Fed doesn't do that. So I thought that was really important. Financial inputs are important. The market, if you look deep in the market, it tells you what's happening with the gold price. Gold looks through a lot of these things. And although there's no fundamentals right now for gold to be doing well, it's doing well. So it's looking through as to what's going to happen in the next few months.
So, looking at this rate hiking, let's say the end of the rate hiking cycle that we're likely facing here, what do you think is next for the economy specifically and the markets?
Right. So the leading indicators tell us there's going to be a recession that's happening. And remember that when a recession happens, to go back to you don't know who's swimming naked till the tide goes out, things always are a lot worse than anybody thought they were going to be, right? Because there's always these kind of bombs in the system that nobody sees until you take away the coverings. So back to 2000 to 2002, you saw the Enrons and WorldComs and these sort of companies that looked like fantastic businesses. All the analysts had buy ratings on them and things like that. But you take away, even back to Bernie Madoff, right? You take away all the juice and to start to take the layers off. That's when things are exposed, and that's, I think, what we're going to start to see in the next little while. And usually it happens in the financial system, right? Because usually, banks are leveraged vehicles. They take in your money, lend it out, but they leverage that, and that's how they make their profits. So obviously you're going to start to see those sort of blow-ups happen. This banking one was the first one, but I think we're going to see rolling issues, back to the whack-a-mole. This bailing out the banking system is going to cause something else to happen, right? It's going to cause something else to happen, whether it's commercial real estate or whatever the case is, right? And everything is linked. That's important. So we're going to start to see these issues, and it's going to surprise people as to the kind of these blowups that are rolling and start to happen.
Yeah, it seems that this lag effect of raising rates ends up, as you said, making them play whack-a-mole with all of these different problems that end up coming up as a result of that policy shift. But one thing I want to get your take on here is why does oil tend to underperform gold late in a market cycle? Is this because of the weakening demand due to a recession?
Right. So let's go back to 2007, right? And oil rallied dramatically, and all the metals did. And then we start to go into 2008, and you start to see these, analysts put these crazy targets. I think analysts, when gold was 120, I saw the $200 targets back in 2008. We started to see ridiculous targets for gold now. And, interestingly, back in 2020, we saw a $3,000 gold target from a few analysts, which it just went straight down from there. So we can talk about that too. But I think as we go into recession, and I've said this to people, even during this time here, which the fundamentals for oil are fantastic, but I said, if we go into a recession or we figure there's going to be a recession, oil's going to get kicked down to the mid 60s or 70 anyway. It's just what happens. It's just always what happens. Demand can still be there, but people are going to push the price of oil down because oil is the ultimate economically sensitive commodity. Right. So as you start to get late in cycle, people start to see a recession. Sure. What's going to happen is oil is going to start to go down in price. There's going to be less demand for oil. And what happens is interest rates start to go down. Real interest rates start to show real interest rates, inflation minus interest rates start to increase and start to decrease. Sorry. And what that means is that gold starts to outperform. So that tells you that we're shifting from economic prosperity to a recessionary environment, and that's when you get that transition from oil to gold.
So, Bob, you mentioned that the environment that you see of inflation in the 70s, and nobody expects that. So, do you see inflation continuing here, and is it because of the cyclical nature of how really the supply chains and the supply in general of these raw inputs to the economy, to the markets everywhere, how they have been underinvested?
Yes, it's been 11 years. I mean, Robert Friedland said one time, sometimes I wonder where the guys on Wall Street think they got their ham sandwiches from. They think they got them from the fridge, right? So what he was trying to say is that people completely underestimate how important commodities are in the world. I mean, I always say to people, look around you. Everything that you see around you came from under the ground or above the ground, right? So everything, commodities are so important to us, and they've been neglected for 11 or 12 years. So it's going to take a lot of time, energy, money. It takes 10 years to permit mines, right? So the work we're doing today isn't going to get anything out of the ground for another 10 years, right? And that means that there's going to be this huge supply crunch, right? The last commodity bull market was caused by, Chinese demand, right? Now, Chinese have stopped building a lot and they've become a lot more consumer oriented now. But I think this commodity bull market's going to be caused by supply issues, right? We just can't increase supply the way we should. So if you actually look at a chart of stock market returns and commodity returns, it's completely inversely proportional. It's about roughly a 15-year cycle. So, let's go back in the 70s. 1966 to 1982 was a 16-year cycle. The S&P 500 was flat for those 16 years. It did nothing. And that was coming off of the late 60s, the Nifty 50 cycle, which they called it, which was all the big 50 stocks. And, it was the place to be and all that. Then we had 16 years of nothing. Well, during that time frame, we had a tremendous commodity bull market, right? People don't realize that from 2000 to 2013, the S&P 500 was basically flat. For 12 years. We had a tremendous commodity bull market. Now here we are 12 years later, 10, 12 years later, and I think we're going to start to see that again, where commodities start to outperform. And your question was, is there a relationship? Why do commodities outperform and stocks don't? Well, let's just say I was a company that made cereal, right? A consumer-based company. So you can see that if my input costs are going down, grain costs are going down, I'm not reducing my price to reflect that, right? So my margins are increased, so my stock does well. So if grain prices start to go up, or any commodity inputs start to go up, I can raise my prices to a degree, but then there's competition, there's other people, so I get squeezed on my profits, right? So my profits go down, my stock doesn't do well. So it just makes sense that during commodity bull markets, when commodities, whether it's oil and gas or copper or grain or anything else, prices are doing well, that general stocks don't do well because their input costs are going up and they can't pass on all those costs. So it just makes sense. And I think we're in that sort of environment right now for the next 10 years again.
I'd like to zoom back into a little bit of the reaction that we've seen, let's say since the banking crisis. We've seen, three real asset classes really benefit in the last couple weeks here. So how do you see long-term government bonds, let's start there. How do you see them performing in this situation? And are they a perceived flight to safety despite a current negative real rate of return?
Sure. No, I like to look at investments. I heard Jim Rogers one time. He says, when he managed money, he says, if there's nothing to do, don't do anything. And he said, everybody figures in the market, you got to be in there doing something every day. But he said, when you find a pile of money sitting on the floor and everybody's just stepping around it, he said, we just go over and pick it up and put it on our desk and wait for the next pile of money that nobody sees. And I think on the long-term bond side, I think that's the case right now, right? So you look for these asymmetrical return profiles where you have not much downside and lots of upside, right? If we don't believe that interest rates can stay at these levels and the economy do well and interest rates go down, long bonds are a pretty attractive place to be. A lot of people don't realize that in 2022, TLT, which measures kind of long-term bond index in the US, there was a point where it was down 40%, and it ended the year almost down 30. These are bonds. These are safe investments, right? And that's why these banking crisis is happening right now, because that was the worst year by far in history for bonds. And I have a lot of trouble believing that we're not going to get significant snapback in those prices. So we're going to see anywhere from 10-year to longer. We're going to see a big compression in rates. And when we see that, you get big capital gains in bonds. So that's why, long bonds, or let's say 10-year bonds, are kind of a proxy for gold. All the reasons why gold does well and people are attracted to gold, the negative real rates and all this sort of thing, are the same reasons why bonds do well. So it's interesting that the two of them represented a great proxy. So in our accounts, we've got tremendous amount of precious metals, et cetera, that we manage for people. But a lot of the people that said, hey, I just don't want the risk. I've made all my money. I've made my $30 million. I don't want to risk it all to maybe make a little bit more. I have more than enough. How can I profit from where we are? That's where we go bonds, 10 years or more, because they might not get the 100 or 200% returns. But in 2008, long bonds were up 35%. Big return for, and it offset the stock market. Stock market was down 35, long bonds were up 35. If you had this, what they call this barbell approach, you would have got through 2008 without losing any money. Easier said than done, but it was possible on the long bond side.
But don't you think, Bob, that the barbell approach is no longer applicable in this new monetary regime?
In some respects, right? It didn't work last year, right? Bonds got hit harder than stocks got hit, or about the same. But I do think that we're in an environment now where bonds are going to give you the protection over stocks, right? I mean that doesn't. We're not going to get slammed on both of them all over again. 2007. Right, we had big credit issues. Bonds didn't do well at all in 2007, and stocks were kind of iffy. Right, there were a few that did well and a lot that were kind of doing well. 2008, once we got into the recession, once we got into the big problems, that's when bonds start to outperform. So nothing is the same as it was in the past, but I do believe that with interest rates up the way they are, the Fed's given themselves a lot of cushion to come down from there.
And of course,
good point though. Would I buy a long-term bond and hold it for the next 10 years? Or would I buy a 20-year bond and hold it for the next 10 years? No, I don't think so. I think we had starting in 1982 until the last 3 or 4 years, we had this massive bond bull market. You just couldn't lose money in bonds. Interest rates kept going down, so you're making capital gains, you're making interest. What a fantastic investment. Going forward, we're into a bear market for bonds for a long time. Now, you might think I just contradicted what I said, but during long-term bear markets or long-term bull markets, there's counter-trend rallies, which are huge, right? And I think that's why I'm saying the long bonds are probably a pretty good bet.
Again, just the idea of being nimble and understanding what you're holding, right?
Right. Exactly. Understanding what you're holding, why you're holding it, and being flexible. Not believing your own hype a lot, right? People people are always right at some point along the cycle, but you gotta understand that things change.
Right. So let's say the other side of that barbell, having stocks, and of course we've seen that these large cap growth names are a perceived flight to safety. Do you think that that's a risky bet in this environment where these interest rate lags are still having their effects yet to be felt on these type of stories?
Yeah, I think so, and I remember again back in 2000, I remember a growth manager pounding the table and say, "I don't care about valuations, I don't care about PE ratios, as long as my stocks are growing, they go up in value." Well, that worked in the 90s, and then he was scratching his head and just couldn't believe why his stocks didn't do anything for the next few years because the company's growing, it's getting better, they have better earnings. Well, great, but the market's not willing to pay the price that they're willing to pay anymore. They're not willing to pay 70 times earnings. They're willing to pay 20 times earnings. So yes, people are keeping going back to last year's winners and last decade's winners because it makes you feel good, right? It's like, oh my God, the stock that was up 1,000%, it's down 25%. And I'm getting it at a 25% discount. Well, not necessarily, right? I mean, it might be maybe it should be worth 20% of what it was worth. So what happens? And I think we've been seeing that, right? And that's why this huge run back into the growth stocks. So a lot of these stocks are now trading at 60, 70 times earnings again, right? And people are running back into there. And we saw that exactly happen. And I think that's why I study history so much. We saw that happen back in 2000, right? We had this huge decline in the tech stocks. And then they rallied back 8 months later, right back to their highs again. Everybody felt good. Oh, I'm back at my highs. This is going to be wonderful. And then you got the next leg down and the next leg down and the next leg down. And the NASDAQ ended down 75% over where it was 2 years. I think we keep going, back to history because history tells you a lot about how people react to things and the emotional abilities. And I will say, interesting enough, in the gold sector, probably one of the most prominent names is Eric Sprott. And in 2000, late 2000, he recognized that exactly what I'm saying right here. And he started up a hedge fund. He shorted NASDAQ stocks, and banking stock, et cetera, shorted economically sensitive areas. And he went long gold. Now, can you imagine, that trade? And I think we're into that environment right now, where gold started to outperform the S&P to be short the S&P and long gold, and he was up 200% over the next 2 years in a generalist fund, which is pretty incredible.
Mm-hmm. So out of those assets that have benefited recently, why do you like gold the most?
Right, gold is the ultimate macro asset, right? So what do I mean by that? Gold's the only asset in the world where we kind of dig a hole and take it out of a hole in the ground, and then we transport it over to another hole in the ground and we put it in that hole in the ground, a vault, right? Now there's some uses for gold, right? But not many, right? Talk about silver, but so that's why gold is the ultimate monetary metal, and people are attracted to gold based upon the interest rate cycle, the macro cycle. Some supply and demand is super important, right, for the physical, but the markets, like it or not, are controlled by the futures market, and people like gold when real interest rates. Talked about with real interest rates before. We talked about what happens to nominal interest rates when we go into recession. Those are all the reasons why people like gold, and I think we're right on the cusp right now. Gold tends to do the best when the Fed starts to reduce interest rates, or there's a sniff of the Fed starting to reduce interest rates. So again, back to 2018, October of 2018, sentiment was blown out. The Fed had been raising interest rates. Then the market started to sense that things were going to go a little awry. Maybe a recession was due. And in later 2019 and had this massive run, right? Nobody knew that 2020 was going to happen, but we were actually going into a recession and the economy was slowing dramatically anyway before 2020. And all they did was they kind of pushed it 2 or 3 years by printing all the money. And then now we're kind of back to where we were in 2018. So that's why gold is sniffing out that we're really at the end of this cycle now, and recession is coming.
Mm-hmm. Yeah, Bob, you said earlier that there aren't really any fundamentals for gold, needing to be this high right now, but maybe pushing back on that a little bit, seeing the central bank demand over the last year would indicate to me that is smart money moving into the metal. So would that not be also, a check in gold's pocket that is positive for the fundamentals?
And it's funny, it's debatable whether central bank demand is smart money or not, right? I mean, a lot of central banks in the world sold out all their gold in 1999 at the bottom. But like you said, I think that it's a lot of these smaller central banks, which I think are important, which are trying to diversify away from the U.S. dollar and realize that there's a lot of risk there possibly as to why they're buying, and from that perspective, yes, I think that's something to take note of on the supply side. Now, interesting enough, as gold has been kind of going up here, and silver, the ETF demand has actually, they've been redeeming, right? So there's been no money coming into the ETFs, and I think that's very important, because if we saw ETF demand kind of going up like a rocket ship and central bank demand at the same time, I would be very cautious, right? I'd say, oh God, but we haven't even seen any demand come from retail, institutional, or the ETFs yet.
I want to get your take on, let's say, the mismatch of the gold price versus the miners. We talked about the cost of the cereal manufacturer, and if their input cost goes down, their margins increase, right? But we haven't really seen the miners catch up with the price of gold really yet. We haven't seen that excitement come into the mining sector. So do you think that the input costs for the gold miners is what's affecting that so dramatically at this point?
Sure. I saw a great chart the other day. It showed a lot of the senior miners were 12 to 1300 on their cost of an ounce of gold right now, right? Some of the smaller ones are at 1500, right? 1600, which is well below what the cost is right now. But I think what we saw last year is, unfortunately, when you're a mining company, you have input costs too, just like the cereal company, and your input costs are energy, and energy primarily, but also other metals and things like that to build your mine, and you have labor input costs, right? So what you see in the first phase of kind of the bull market is that and incidentally, gold was flat last year, basically in 2022, which would made it one of the best assets out there. but everything else got hammered: gold, stocks, bonds, etc. But the stocks were down, 25% for the big ones, and 50% or 70% for the little ones. And the reason for that is because, yes, ultimately it comes down to profits, and profits got squeezed with the big companies, because the big companies' cost of production might have been $900 an ounce, and it went up to $1,200 an ounce. So although gold stayed flat, if your profits got squeezed, your stock goes down. So I think we're in a fantastic environment right now, because yes, the stocks are reflecting the fact that their earnings just got squeezed, but that's behind us. So now, if we can, get inflation under control, so it's not running at 10 or 20% or whatever the case is, then their costs are going to increase moderately, but the gold price is going up a lot more dramatically. So you're going to see this huge expansion of earnings. And remember, it doesn't matter whether it's gold stocks or tobacco stocks, right? If money is coming into the sector, then you're going to get multiple expansion. So in other words, your profits can stay the same, But if the market's willing to pay 20 times earnings for your stock instead of 10 times earnings for your stock, right, your stock's going to double, right? And that's what we saw a lot with these big tech stocks in the last few years. The earnings were fine, but the market just paid a lot more for them, right? So, and that's what people fail to realize, is that even if these earnings go up with the tech stocks over the next few years, if you get multiple compression, the stock's going to go down in price, even though your earnings are going up, right? So I think right now with the mining stocks, where they're kind of reflecting the fact that the profits got squeezed, but we're going to see this huge expansion in profits. And then on top of that, you're going to see multiple expansion where the market's willing to pay more than they were willing to pay. And that's why mining stocks and value stocks, right, even outside the mining sector, I think we got a great few years ahead of us for both those areas. And that's why you tend to get these, fantastic gains, more so than you could ever imagine, because the earnings plus that multiple expansion. And you asked a question about kind of the stocks right now. If we are in a true mining bull market, right, and I don't think the market believes that yet, or else the stocks would be trading a lot higher, right? Because there's been so many times where it just goes up and gets hammered down again, up and down, right? One of those times it pushes through, and most people will miss it, right? Again, going back to only a few people make a lot of money, right? So no pain, no gain. If you didn't go through all the pain, you're not going to get the gain. That's right. That's the way it works in life. So the companies, if we're in a true mining bull market, the companies that'll do the best from a stock perspective will be the companies that have the highest all-in sustaining costs, right? If you're a gold company and it costs you $2,000 to get your gold out of the ground, your stock is pretty bad right now, right? Because you just if for every ounce of gold you're taking out of the ground, you're losing money on it, right? But if gold goes from $2,000 to $2,500 an ounce, you just increase your profits dramatically, right? Whereas the company with a very low cost of production increases their profits a little bit, right? If gold goes up more, so their stock's not going to go up as much. So the place to be in a real big mining bull market is the companies with the highest all-in sustaining costs. So let's just give you another example in silver, for example. $10 an ounce is what it costs to take silver out of the ground, for example, for your company, we'll say. And we'll say silver is $11 an ounce, right? You're making $1 an ounce. It's okay. You're making a 10% profit. But if silver goes to simply $12 an ounce and your cost is still 10, you're now making $2 an ounce. You just had 100% price increase. 100% earnings increase. And the price of silver only went up 10%. So you see how the leverage is dramatic, and you see how the price of silver can go up 50% and the stock prices can go up in most of that.
Right. Yeah, that's an interesting way to look at it. And you and I were talking before we hit record here about this, the idea of institutions moving into the gold sector, not necessarily because they like the gold sector, but maybe because it is outperforming the rest of the sector. So do you see that as, something that is coming into play here for the generalist funds here?
Definitely. And by the way, generalist funds have about 0% of their money right now in gold stocks, right? The last time it was this low was 2000, which I think is fantastic, right? When they get up to market weight, you want to start to be careful of the industry, right? Because they'll never be over market weight. But if market weight is 8% and they're at 0, I mean, how much more can they sell? They can't, because they don't own any, right? So we're in that environment right now. But what's most important is, hedge funds a lot of times get paid on a quarterly profit, right? So they get their performance fees based upon quarterly profit. So they're always searching around for what's going to be the best in the next few months. And what we've started to see, what we've seen over the last little while is that, gold might be up 10%, but the S&P 500 was up 15%. So, gold goes up another 10%, the S&P 500 goes up another 15%. So big deal. Gold's up, but so is everything else. So what you want to start to see is that gold is outperforming the S&P 500, or the NASDAQ or whatever the case is, right? And we've been on a pretty severe downtrend for years now, where gold might have been doing well from 2016, late 2015, where it bottomed at 1,000 until now, but the S&P was doing better. So that's a downtrend. So right now, what we're starting to see, and we're right on the cusp of that, and it's interesting today, with the S&P 500, I'm just looking at my screen here, down almost 1%, gold up 2%. Today actually might be that day where the breakout happens. We've been very close to it. And when that breakout happened and it's sustained, where gold stocks are doing better than the S&P 500, that's what they're going to start to look at, and they're going to dive into the sector wholeheartedly. And as I said, with the 0% allocation right now, it doesn't, there's, tens of billions of dollars start to come into the sector. Casey Research, right? Casey said a long time ago, he said, when money comes into the gold sector, when significant money comes into the gold sector, it's like, he said, it's like a river going through a pipe. Is how fast the things go up because it's such a small sector. And interestingly, he said in the uranium side, he said when money comes into the sector, it's such a small sector. He said it's like a river going through a straw, right? How fast things go up. But for the whole commodity complex, it's so underinvested right now. I mean, energy stocks in 1980 were a significant portion of the S&P, right? Right now they're 2 or 3%. Even with the big run we've had, they're 2 or 3% of the whole S&P 500. What if that goes to 5 or 6 or 7%? That's a massive outperformance. Same for gold.
Mm-hmm. Well, that brings up the idea of the mining clock. So I'll pop that on the screen right now and explain to us. That's a concept that you and I touched on last time. But explain to us, let's say, where we are in the mining clock and what it is.
Right, and the mining clock is kind of interesting because it doesn't, it can take a long time to go from 1 to 2, and then a short period of time to go from 2 to 3, or whatever the case is. But I think why the mining clock is so important, and we've modified this from the people that invented it, is that it is a cyclical sector. We're going to get all of these things that happen along the way. And it's really a function of credit, and it's a function of access to credit. So let's spend a few minutes on this because we have time. I think it's so very important because when things are bad and sentiment's terrible, the market will be telling us where we are. When things are good, you got to recognize what's happening in the market and realize that we're coming to the end of a cycle. And this really quantitatively helps you to focus on it. So let's start at 1 o'clock. So we can equate that back to 2012, 2013 in the mining sector. So the price of the commodity starts to go down. Companies' costs are very, very high, and we'll talk about that in a few minutes, why their costs are so high. So obviously they're getting squeezed. They better start cutting costs, right? So you've got the mining companies have the private jets and all this sort of thing at the top of the cycle, right? So those go away. These tech companies had thousands of employees where nobody actually knew what they did, right? So they're getting rid of those companies. They're getting rid of those people right now and cost cutting. So this isn't just for mining, it's for any sector, but it particularly pertains to mining. Number 2 is you get company liquidation. Some companies can't cut costs enough. They're over leveraged, so they go out of business. Then you get number 3, which is the asset write-downs and credit downgrades. So back to mining, we saw that in 2014, 2015, where companies that, and I can think of various projects where a company came in and paid $1 billion for a project. They write it down to 200 million, right? So massive write-downs. They don't have to liquidate the company, but they're going to get credit downgrades from that perspective. So that's a pretty nasty area from 1 to 3, but it's necessary, right? It's a necessary part of the market. And why do I say it's necessary? Because you're not going to get the rest of the cycle unless the weak perish in 1 to 3, right? When you keep bailing out the system, like they keep doing with the Fed here, you don't actually go through that. So you have all these zombie companies running around which shouldn't be around. Doesn't happen in mining. They're never going to come out and bail out the mining sector, right? It's not important enough to the Fed to do that. So number three was the end of 2015, right? Then we get into metal prices stabilized. So finally, gold went down to 1,000. It hit its rock bottom. Interesting enough, most of the companies had brought down their cost of production dramatically, right? So they could survive by doing all of the things they did in 1 to 3. So we get into 2016, metal prices stabilize. Now, what happens when metal prices stabilize is you start to get some cash flow. So the companies actually are starting to be profitable. And when that happens, they start to pay down debt right away, right? Obviously, because they're over leveraged, you got to pay down your debt or you're not going to be in existence anymore. So again, that's 2016, 2017. Then what happens is companies, this is a multi-year process. Companies say, wow, if we have 35 million ounces of gold in our reserves, and that used to be 50, but we've had to reduce all those down because they're not profitable at these areas, and we're producing 5 million ounces of gold a year. We don't have any gold in 7 years. We don't have a company anymore in 7 years unless we start buying somebody. So you start to get cash takeovers, right? Companies are very, very cheap. The juniors are very cheap, and they come in and they start to buy out the juniors. And we saw that in 2016, right? We saw a whole raft of good quality projects start to get bought out in 2016. So that's the cash takeovers. That happens very, very healthy. And I think the mining clock is so important because the market, what's happening in the market tells you where you are in the cycle. Very important to realize that. So, and it takes away the emotions. Cash takeovers were very important. We've kind of got stuck for a few years between 6 and 730, right? Because we've had these ups and downs in the mining market, and we've had these big collapses. We had COVID, and we had lots of issues happen. And I think the regulatory environment is kind of stopping a lot of these new flotations of small stocks, right? But we had a lot of private placements, right? So we had a lot of private placements done in 2020. That was kind of that proxy for the new flotations. Companies need money, right? So credit's very important. If you can't get access to credit, and from 1 o'clock to 6 o'clock, companies really can't get access to credit. Make a major discovery if you can't get access to credit, right? So what starts to happen at 7 o'clock is, I don't mean access to credit, I mean access to money, right? Credit or equity. People are willing to give you things. So here we are, around 7 o'clock, we started to get a lot of capital came in 2020. Well, that's fine. The stocks are down from then. We kind of had a mini bear market for a couple of years, but the companies raised $50 million and they have that money. So they've been spending the money for the last couple of years, finding new deposits. So that's when you start to get rising exploration. Then you start to get discoveries that are made, right? I think we're in that area right now. There's still a lot of big discoveries, but there's a few that have come around. Companies are using their capital. But what happens is these big discoveries happen. You get these stocks that are 10 baggers, right? Or 15 baggers or 20 baggers and taken out. Then everybody says, oh, okay, we want the next one. Who's the next one that's going to do that? Mm-hmm. So prices start to go up a lot, especially with the juniors. We haven't seen that at all yet, right? It's been all the senior stocks have been the interest, where the interest has been. I think if this is the sustainable market, we're going to start to see the juniors really start to outperform. Then the juniors become very expensive, right? And when they become very expensive, large companies have to start taking them out again, right? So the debt rises, debt with the big companies. And when the debt rises, they get to the point where they can't take on any more debt. So now they have to do paper takeovers. And a paper takeover is when you issue stock in your maybe overvalued company to buy stock, to buy another company that's overvalued. And I think, what's really important here is let's go back again to not mining, but the marijuana stocks, right? Or the cannabis stocks. So back in 2017, right, we saw companies that were worth $6 billion, that were worth, or using paper to buy out a stock that was worth $1 billion, that was worth nothing 6 months before, right? So paper for paper takeovers were happening. And that told me at the time, I said, Okay, this is going to be a big problem for this sector because we're getting near the end of the sector. I think we're in a position over the next 5 years where a lot more people will be using cannabis, but the stocks will be down 70 or 80 or 90%.
Mhm.
And people said, how could that be? What do you mean? Did the fundamental best stocks are down 90%? And I said, yeah, because people paid way too much and they were way too enthusiastic about it. That will happen in mining. And I repeat that, it will happen. This sector, it will happen.
Mhm.
In oil and gas, it happens in cannabis, it happens in biotech, and it'll happen in mining. We aren't there yet, but in a few years we'll be there. We'll be there, and you just got to take note of that and say, okay, that's when you feel the best. That's the point of maximum risk. Then at 10 o'clock, you get people leaving the big companies because they say, oh, I'm struggling away here for what I'm making as a geologist at, this major company. Look at this junior stock. I mean, I would have got stock and I would have been a multimillionaire by now. So they start to leave those companies. They go to the junior companies. That tells you again that that's a trailing indicator. And then you start to get aggressive selling. And then, of course, who is the ultimate trailing indicator? It is governments, right? Governments are hugely reactive. They're never proactive, right? They're never proactive. They always react to something that happens. So what happens at 12 o'clock is the government say, wow, these mining companies are making way too much money. We should have a piece of that, right? So whether you're a developing country, and you say these people are taking our gold and silver out of the ground here, and we should have a bigger chunk of it. So we're going to increase the royalties, we're going to increase the taxes, or here in Canada, either way. Governments say, wow, they're making way too much money. And that's right at the top of the cycle. So they raise the taxes dramatically and completely kill the sector, right? Because we're actually going into a bear market. So now we have high taxes going into a bear market, which makes your profits get squeezed more. And I know I went on a long time about that, but I think that mining clock is so very important because it tends to help you focus where we are in the cycle.
Mm-hmm. Well, Bob, I want to get your take on, let's say, identifying the companies that you want to be holding or that make themselves really attractive to you, maybe despite even the mining clock. You talk about holding a company for the next decade. Is that a good identifier of businesses to you that you want to own because they are so solid and that, in some ways it's a good exercise to think about something that you would want to hold for that long?
Sure, there's sectors that there are stocks that outperform for long periods of time, right? And I think in the mining sector, you'd have to look at the royalty companies that do that, right? Mm-hmm. Royalty company, it doesn't matter to them if they have a diversified portfolio what's happening to the gold price necessarily. I mean, they're buying it way below the gold price. They've got their profits guaranteed, no matter what the gold price does. Now, if the gold price goes up, they're making even more money, which is great. But they have that cushion always. Whereas if you're a mining company, you make a discovery. There's been a few here in Canada that I won't name. They were fantastic companies, right? And suddenly the stock goes to zero because the project actually, when they started to get in production, didn't turn out the way it did, or the walls caved in, or you got flooding, or whatever the case is. So there's so many things that can go wrong with mining. So the royalty companies kind of avoid a lot of that because they have that natural profit that's built in there. It's not that easy, but obviously it's a way to kind of take out a lot of the risks of having a mining company. So yes, we could go into a great mining bull market, but there's going to be lots of stocks that do horribly, right? One of the best geologists, exploration geologist that I pay attention to, said he hates to see yellow trucks show up on a site. What do we mean by that? Most of the money is made with these juniors when they make a discovery, right? Once they go into production, that's when the yellow trucks come out, right? And that's when that there's big risks when that's the case, because rarely does the production happen as it should, right? So as we get later, as we're getting early in the cycle, the large caps, even though they might get profits squeezed with inflation or whatever the case is, tend to outperform and do extremely well. Secondly, when money starts to come into the sector, it goes into those stocks first. As people start to realize that we're in a sustained bull market, then it flows downhill, right? So then money goes into the mid caps, then money goes into the exploration stocks, and you get these fabulous gains. And usually, the junior market outperforms for a year. It's right at the end, and it's just going to be massive gains, and then you're kind of getting near the end of the cycle. So that's kind of how money flows. The seniors first, the mid cap, then the juniors. So you're not necessarily going to want to be holding too many juniors for the next decade, right? Mm-hmm. To hold a senior company or royalty company, sure, that's a way to keep exposure to the sector. Does that kind of answer the question?
Yeah, absolutely. Yeah. I think that's a good way to break it apart there.
Mm-hmm.
Bob, we've talked a lot about gold, and let's say the broader commodity complex as a whole. So what are the other sectors within that you're really watching and bullish on? Is it energy, uranium, base metals? What other areas of that commodity complex excite you?
Sure. I went to the Vancouver Resource Conference recently, a couple months ago, mm-hmm. and one of the guest speakers up on stage was Ross Beatty. And he's one of the biggest names, obviously, in the industry, been around 4 decades or more. And it was quite powerful for him to say that never in his entire career had he ever seen all metals, not just gold, but all metals lined up to have massive gains going forward here. Copper might do extremely well sometimes, but that's a bad environment for gold or whatever the case is, right? But he said everything he sees out there is there's positives for it going forward here. The macro environment for gold, but also the supply demand and electric vehicle energy transition for the base metals, for example. So yeah, I think we're in for and that's why I think that 2000 to 2010 is a great kind of proxy for where we are. I think gold's got some great places to go. Obviously, the gold stocks, if we're in a sustained market, give you more leverage than actual gold. Silver is an industrial metal, right? Silver at 80 to 90 to 1 now, as far as the gold to silver ratio. It doesn't mean silver is going to go up dramatically, but remember that it kind of bases down at those levels, right? I mean, it reached 110 to 1 back in 2020, which is crazy. But at the end of a bull market, a lot of people say it should be 8 to 1, right? Well, let's just say it's 30 to 1, right? Or 40 to 1. That means gold's got double the upside in a bull market or triple gold when things start to go up. So silver also 60% of it is industrial production, whether it's solar panels or all the other things that we need for this energy transition. So that just gives it another little boost on silver. Copper, no money's been spent, right? Most of the copper coming out of the ground is still from Chile, mines that were built 70 years ago, 60 years ago, right? And their grades have gone down to just minuscule amounts. What people economic, but just because of technology, they're still economic, but there's nothing to replace those. And the amount of demand on the other side for copper is going to be absolutely incredible. And all the other energy metals. Uranium, right? Obviously, since Fukushima, there hasn't been one penny gone into the find more uranium, basically, for many, many years. So I've never seen something transition this fast, where in the last year, all these countries who are so negative on nuclear power have all become so positive all of a sudden, right? And that's because of carbon-based, trying to transition from the carbon-based area. Mm-hmm. So I've covered most of the metals there, and it's just pretty positive for most of them. I mean, if you believe that people are going to eat, we're still going to survive, we're still going to drive our cars, then sure, we'll get through whatever this economic calamity is coming at us right here, but we'll get through that, and that demand's going to be there for all these metals.
Mm-hmm. One of the last things I wanted to touch on with you here, Bob, is, as you mentioned, this whatever this economic calamity looks like that we're facing. I'm sure a lot of the listeners of the show understand that we're facing something pretty serious here. How do
Sure.
you think about capital preservation and about being defensive in this unstable and volatile environment? The
Well,
idea of not getting killed in order to kill it.
right. And I focus a lot on that because again, managing money for mining executives, they say I've made all the money I want to make. I mean, I have more money than I just don't want to lose it all. So just make sure we're still participating, but not losing it all. So yes, in that sort of area, for a generalist portfolio, for example, and this will help you to make the right decisions at the right time. Let's just say, the average institutional allocation right now is 0 for gold. I presume most people that are listening to the show have a lot higher percentage of their portfolios in gold. But let's just say you want to say, okay, I just don't want to get blown up the next time things go badly here, but I want 10% of my assets in gold, we'll say, or precious metals. Mm-hmm. Let's just say that's a number that you came up with. So gold stocks double, right? The rest of your portfolio doesn't. They become 20% of your portfolio. Well, strategically, you say, okay, I'm happy with 10. So sell it off, pull it back to 10. There we go. Great decision making. Now, if you want 10%, and again, that's not recommended. I'm just coming up with a number here. And your gold stocks go down by 50% compared to everything else in your portfolio. They now become 5%. Well, great. Buy more, bring it back up to 10%. Now you're actually making the right decisions at the right time, right? So, and you're not gonna kind of blow yourself up in a really bad market. It's very important to have things in your portfolio that do different things at different times. And that's what I always tell kind of our higher net worth clients. Nobody knows what's going to happen in the market in the next 6 months. Gold market, equity market, whatever the case is. And if somebody says they do, then, if they're right, they're lucky, because they won't be lucky next time, right? So what you do is you just say, I don't know what's going to happen in the next 6 months or a year or whatever the case is, but I know how certain assets are going to perform if this happens, and I know how other assets are going to perform if this happens. So you put those into the portfolio properly, then you can say, okay, if we go into a severe recession here, we've got long bonds. Great, those are going to rally dramatically. Now our tech stocks or whatever are going to get hit, right? Our gold stocks are probably going to do well. Then rebalance that, right? So that way you've got. A lot of people think they have a balanced portfolio because there's 6 banks here in Canada and they own all 6 banks. They're like, oh, I'm diversified among the banks. No, they all do the same thing at the same time, right? You don't have a diversified portfolio. If you have long bonds in your portfolio and you have gold and you have tech stocks and you have some utility stocks, you're balanced. You've got a portfolio of things that are going to do different things at different times, and that's the key right there.
Perfect. All right, Bob. Well, I think that's a good place to kind of wrap up the chat today, unless there was anything else that you wanted to
add. Not really. We do a 2-pager newsletter because nobody reads a lot these days called the Gold Digger, which actually talks about the macro environment for gold, but also about all the other things we've talked about. And it's complimentary if you want a copy of that. It's Thompson Investments at raymondjames.ca. But other than that, I think that covers everything we want to talk about.
Perfect. And of course, you're available on Twitter as well at Bob Thompson RJ as well, right?
That's correct. Yes.
Perfect. All right, Bob, thanks so much for your time today. Really appreciate you going through the mining clock and all of the other ideas that we touched on today.
Fantastic, Tom. Had a great time. Thanks.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.